Gotta unmute. That's the main thing to do at the beginning of these streams. Welcome everybody. It's the Thursday financial thing live stream. Of course, I am Lawrence, your host. Thank you very much for taking this evening to come hang out with me. Come talk about investing. As always, if you can hit that thumbs up button, it helps out the channel a lot. Subscribe, all of that good stuff. What are we talking about this evening? Well, do a little bit of Pitto news, as always. I've been thinking about the Pitto Pit companies that have gone out of business and what total amount of companies went out of business in relation to how many companies they were. Those numbers, they seem high. You know, if you look at the grand relation of, if I had to take a guess, and this is not an accurate number, I'm sure, but if one were to say there was 50 companies and, you know, we lost Funding Secure, Lendy, Thin Cats, maybe 7, 8 companies. That's a pretty decent size, isn't it? You're talking about 15%, which doesn't make the sector look good on paper. You know, unfortunately, those early companies that went out of business were the early companies, so this is when the sector was new. And if we take into account the companies that did voluntary wind downs, like Landing Works, the names have slipped my mind right now, but there was a few voluntary and a few involuntary. But yeah, I was talking to somebody about that last night, saying, wow, if you look at this as a relation to the total number of companies that existed, it doesn't really look good on paper for the industry. The good thing is it seems to really started to settle down now with, you know, quite a lot of companies offering a pretty substantially solid product. So if you were an early adopter into Pitto lending, you kind of got punished in a way, which I know many of you are. Some of you are newcomers, but if you're an early adopter, you just really kind of got a little bit punished. Unfortunately, it's just part of sometimes when you get in early that's what happens. There's always a case to say, well, maybe waiting for a sector to mature before you invest is a better way. But I think a lot of us too, we get sort of glazed over by the the potential in things, you know, by the carrot dangling in front of us, that interest rate carrot, especially when interest rates are low and, you know, interest rates are 3%, you're getting a company that's saying, well, we can pay you 10, you know, like Lendy did. And they dangle that carrot in front of us, and there's a certain amount of greed that exists, I think, in all of us to want to get those high rates of returns, and then we jump into things maybe that, you know, with further research and due diligence would not be the best things to jump into. But that is part of the investing experience and the investing roadmap, that if you are going to take risk and try to get higher returns in life, sometimes you have to learn some lessons and take some lumps, unfortunately. But I digress on that. Today we're going to talk about some Pitto Pit lending news. We're going to look at the Pitto Pit lending awards that were handed out by the Pitto Pit Finance News, which has changed its name, I think, to the Accredited Investor, or whatever they call themselves now. Alternative Credit Investor, there we go. We're going to look at who won the awards, who was blessed this year, and the criteria about how those awards are handed out. We talk about an interesting email I got in the financial thing email bag. What do you call it? A mailbag? And answer something about just kind of general investing, stock market stuff right now. We're going to talk about the Bank of England interest rates today and what happened with that. So altogether, just kind of a general investing topic. So hope you are having a wonderful weekend. Thanks for joining. I have a quick shout out to everybody. As you can see, Holly is having a snooze in the background. But again, thank you for joining. So let's say a quick hello to people in the stream. Patty is here in français. Bonjour, ça va? Comment tu t'appelles? Mark Mason, hello, Mark Mason. Nice to see you from Chile. Sorry. Dave Dawson in wet Staffordshire. Colin, and I'm sure always sunny Peak District. Peter Vince, hello. Peter in Leatherhead. Lionfish down in the Caymans. Nice. Hi, Mike Powell. John Day is here from a Dampish, Nottingham. Paul Bagworth, as always, in Kenilworth. And yeah, here we go. So, welcome if you're watching in the future too. Tune in live Thursday evening. Hopefully every Thursday. Let's get straight into it. We're going to have a quick look at LPAD. It's been a while. Sometimes I like to check in, see what's going on with their numbers. If you're not a LPAD investor, I mean, this is, in my opinion, one of the safer platforms that has been doing a really good job, even through the pandemic situation where a lot of peer-to-peer companies froze or lost liquidity. LPAD was able to continue to offer it through exit strategies, which is pretty impressive. We have now 83.6 million in LPAD loans. Total loan value of 158 million. We still have this very low average loan to value at 41. That's dropped a little bit less than I checked. It was 42%. 181 live loans. Average loan size 462,000. This number has jumped a lot. Total lenders from when I started tracking this in the 3,000 range, now up to 5,186. Interest coverage fund is still 42 grand. Nothing committed there, which means none of the loans are needing to dip into this interest coverage fund, which is a very tiny percent of the total amount of loans that LPAD holds. And then, as always, this is what we like to see here. Estimated time to sell. So if you do need to exit, you do need to access your cash. Less than 1 day. And it's been like that from day one that I started investing through LPAD's loans. Now they have a total of 15 lending partners, so starting to increase that. I think you would see more. I think, when I had a discussion with Louis at LPAD in London, when I was there a couple of months ago, their biggest challenge at LPAD, and I think every peer-to-peer lending company suffers from this, but it's just getting new clients, getting new investors to come in and pledge money to, for them to be able to lend out. If they don't have the money from investors, retail investors like us, they can't obviously lend the money out and take on new lending partners. So I think that LPAD probably has more borrowers than they know what to do with, and more loans than they can deploy your money to. There's just probably not enough money, but still a lot out there. I mean, your average lending size here is 16,449 pounds, so that's the average lender amount that people have in. So looking good. Another thing I wanted to do is kind of look at Cufflink too. Somebody had asked me, is there availability at Cufflink? Cufflink presents quite an interesting problem for most people now that they've raised their amounts. By the way, we will have Cufflink on the stream probably in January now, it's looking like, because we're only a couple of weeks away from Christmas. Things kind of go dead, but hopefully in January. Norinda, come on the stream. But yeah, Cufflink has got some opportunities available in the auto invest. And this is kind of what I thought would happen when they raised up their minimum amounts that you have to invest now to £500 per loan. You're going to see more availability, and this is exactly what's happening. There are obviously higher net worth investors out there that have deeper pockets, but you can see some of the loans down here. They're actually paying pretty decent rates, 8.4%, 4.24% funded. So what does one do if one wants to continue to invest in Cufflink and you don't want to put in £500 alone? Well, there really is only one option, and that is to go with the auto invest product. Oh, by the way, speaking of Cufflink, of course I forgot to plug them, but they are generous sponsors of the stream. My information tries to stay as unbiased as possible, even though they are a friend of the stream. I do obviously highlight things if I see them that are not to my liking. Obviously, the £500 minimum is not to my liking, but it is what it is. So anyway, if you don't have a Cufflink account, please go check them out. You can earn up to 9.83% gross per annum. I would say over £300 million of property-backed UK investments have now been made since 2016, and zero investor losses to date. Remember, your capital is at risk. This is an investment, so your capital is at risk. You could lose everything. Don't invest unless you're prepared to lose money. By the way, very unlikely you would lose everything, but it's always a possibility. Your interest rate returns can change as interest rates change. You can sign up at join.cufflink.com/financial-thing. Thank you for bearing with me while I read that. So what is your option if you are a Cufflink investor and you don't want to invest £500 in a loan? Well, you could put it in the auto invest product. That's probably the easiest way for most people. You could choose a 1 year at 7% gross, 2 year 8% gross, 3 year at 9% gross. And you could do it for a minimum of 500. So rather than having to put in 500 into single loans, which could leave you somewhat exposed if you don't have a large amount to invest, you put in the auto invest product and have automatic diversification. Of course, there is a downside to that, is you get paid at the end of the year, 1 year period. So, if you're somebody that likes to see those loans turning over, you're not going to get that with the auto invest product. I think that was one of the biggest downsides, unfortunately. But it does allow you to invest for a much smaller amount, because really you need a minimum of 5 to 10 loans in any of these peer-to-peer platforms to be correctly diversified. But if you are somebody that has the 500, you can go ahead and find opportunities within Cufflink to invest in. So there's plenty of stuff out there. Let's go to Assets Exchange. They have launched their new feature, which is pre-launch buy orders, which they listen to investor feedback. They're launching new properties in pre-launch status. So before the property has been purchased and the loan is drawn, this will allow investors to place pre-launch buy orders ahead of the purchase in whatever size they wish. When the property completes, the pre-launch orders will automatically convert to regular ones. This feature will work in conjunction with cashless buy orders, therefore allowing a target buy size to be set, which, subject to there being a corresponding sell order, will trade whenever cash is added to an investor's account. Sounds complicated, huh? Basically it's a demand and supply product. So similar to stocks and shares, if there's somebody selling at a certain price and somebody wants to buy at a certain price, then that order gets matched. But at least now you could do it in some kind of a pre-launch status. So if you want to get your piece of the Assets Exchange pies on properties, you can now do it that way. Let's see what else we got. Narinder, there he is, looking very suave, from Cufflink. He says the three major investment trends for 2024, in his opinion, and these areas will dominate the agenda for investors across the year of 2024 is the UK general election, which is next year, 2024. The growing importance of environmental, social, and governance in investing, ESG, and continuing technological innovation. Now, in a year of a general election, see, economic things can happen depending on who wins. Everything is always based on sentiment. I think that goes the same with investing, and especially if you're investing in things like stocks and shares or, say, cryptocurrency. It's all about sentiment, what people feel or believe is going to happen, unless there's insider information going on that we're not privy to. But the election year will bring some economic uncertainty, I think. And that is Narendra's opinion. A new government likely to take power. So we'll see what happens. Narendra believes that the outcome of the 2024 general election will have a significant impact on the world of investing, as the policies and regulations implemented by the new government will ripple across the UK and beyond. So you have to keep an eye out for policies impacting taxation, regulation, spending, and infrastructure. How does this affect peer-to-peer lending? Well, it really affects more than anything. Maybe what's going to happen with the building, the amount of people building houses, developers. If we start to see the economy sort of lift itself out of the doldrums, that helps peer-to-peer lending in many, many ways. So we will have to see what happens with that general election. Keep an eye on it. It's kind of important. Pitto Pit Finance Awards took place and the winners were announced. This is done by the Pitto Pit Finance News website, magazine, and which is now called the Alternative Credit Investor. What I found interesting about these awards is I wanted to see how they exactly decide who wins categories. And what they do is they have a panel of expert judges, which is Neil Faulkner, Managing Director of Fourth Way. I'm still trying to get to come on the stream as a guest. Mike Carter, Senior Policy Advisor at Innovate Finance. Conrad Ford, Chief Product and Strategy Officer at Alaka Bank. And Susie Neurith, who is the Investors Editor-in-Chief, who's been on the stream before, and Contributing Editor Catherine Gore, also participated in the judging. It's kind of an interesting way to give out awards, and they do a whole banquet. This is a pretty big deal. You can see from the picture here. This is not a small affair. I mean, it's all done in person. This is not stuff that's just handed out. So they do a banquet. The peer-to-peer lending reps, some of them come to the banquet and they hand out these awards. But I was thinking, it would be nice if the panel of judges were to be peer-to-peer lending companies themselves, where they couldn't vote for themselves. And I think that would be a better way to do it, just to have a larger pool of people who were to participate, because I think having a small panel of judges it's a little bit opaque as to how they decide who gets to win these categories, even though I guess you have to start somewhere, and this is not something that they've been doing for a really super long time. But if we look at the winners, it's quite interesting. We're going to skip down to some of these ones that restructuring firm of the year. Ugh, that's not something you want to see. We're going to come down to consumer lender of the year winner, Lwise. Of course, Rishi has been on the stream before. Lwise lending to students. I was kind of looking at Lwise on Google. I wanted to see what their Google reviews were, just to see. And these reviews tend to be from people borrowing, so not necessarily people investing. There are a few people that have an axe to grind with Lwise because they couldn't get approved, right? This person, Molly, was saying she was in a very bad financial situation and she was asking Lwise to help. Charge less, but they have not helped, and so gives a 1-star review. There's a couple of 1-star reviews here from people that are upset about their lending practices because they wouldn't approve them for for loans. And one guy said, it's ridiculous that I have to have a job to be able to qualify. I think that personally, that's a really great term and condition that they have with their lending. It's this guy right here, SJ Shark. Pointless service, impossible to get an application approved unless you're fully employed. How am I supposed to be employed and study full-time? That's the whole point of your business. Lend money to students. Well, I would surmise that lending money to students is probably one of the next problem that will explode or implode. Would implode be the right word? You're lending, basically just giving out loans of tens of thousands of pounds, or in the US, hundreds of thousands of dollars. I mean, some of these universities charge so much. And you're basically giving out a loan to somebody that has, in often cases, zero credit, no income, and no assets to back the loan. The student loans are interesting because you cannot wipe them out. They're one of the few things you can't wipe out. If you go bankrupt, you cannot wipe out student debt. So they're really a noose around somebody's neck when they take them out. And a lot of these financial institutions are giving out student loans to people that are just frankly not qualified. Lwise is different because it's for graduate programs, and they're trying to make sure that people are actually qualified to pay the money back, because they don't want to end up like some of these other finance companies that are lending money to students that will probably never be able to pay the debt back. Of course, when that happens, you're going to have people that are upset saying, well, I can't get a loan because I don't have a job, blah, blah, blah. I didn't get approved, so I'm going to give you terrible reviews. But I think the service they're offering is actually a decent service. So they were named as Consumer Lender of the Year, which is interesting because, yes, they technically are a consumer lender, but I think it's a very niche category of student lending. Business Lender of the Year was Folk to Folk. I think that's pretty well deserved. I certainly wouldn't give it to Assets Capital. Stuart Law, who's still declining to respond to my messages of offers to come onto the stream for reasons that are probably very obvious to you. Property Development Lender of the Year, winner Crowd Property. Highly commended Property Bridges. Never heard of them, but I went to their website to take a look. You can actually invest through Property Bridges. This is Irish lending. I don't know what their statistics are like, because I don't think you can see them. I don't see any way to see any statistics, but they've been named as a backup winner, so they're highly commended. Bridging Lender of the Year, Shojin, with Shojin Property Partners, who we've had on the stream. Commercial Property Lender of the Year, Relendex. Okay. Residential Property Lender of the Year, Cufflink. Well done to Cufflink. So there you go. Ethical Lender of the Year, Folk to Folk. So they get a couple of winners right there. Rising Star, Land A Finance, never heard of them. Financial Inclusion Award, the Money Platform. Another kind of consumer lender. So, Innovative Lender of the Year, winner Axia Funda. And then Property Lender of the Year, Cufflink. CO of the Year, Roy Warren from Folk to Folk. IFISA Provider of the Year, Easy Money. Pitto Pit Lending Platform of the Year, the big one, Crowd Property. An Investor's Choice Award, Crowd Property. So Crowd Property doing very well in the Pitto Pit Lending Awards. So we got Crowd Property, Shojin, Cufflink, Folk to Folk, Lwise, Money Platform, all of who we talk about on the stream. Some of them have, actually I think nearly all of them have been here as guests. So congratulations to you guys. I hope that in the future maybe the panel will be expanded to where peer-to-peer lending companies actually get to vote on their peers. I think that would be super cool. Speaking of Lwise, there's Rishi right there. Great photo. Lwise keeps low default rates despite higher course fees. So as education costs and graduate studying increases, Lwise has managed to keep their default rates low. Borrowers pay off the loans once they are in employment after the course has ended. Lwise chief executive Rishi said that less than 2% of the platform's loan book is in default or arrears It's only written off about $24,000 to date. We haven't seen a major effect on the loan book from the current economic challenges as of yet. I believe this is in part due to the affordable rates we offer and the fact our rates are fixed. When it comes to postgraduate education, universities and business schools are able to uncap the fees. We've seen quite high rises lately, coupled with living costs going up. Our borrowers are coming out with decent jobs, though, so they're able to service our loans, which is reflected in our low default rate. So maybe I got that wrong about Lwise. Maybe they don't require you to have employment in order for you to get a loan. Maybe that person on Google was denied because they didn't fill out the application right. Who knows? So good job to Lwise for keeping their default rates low. European investors take higher risk in search of yields. Household assets in Europe have grown by 51% over the past decade. So they've grown to 29.3 trillion pounds by the first half of 2023. There's been some interesting changes in the structural view of a investment portfolio, Robocash said. Over the last 10 years, cash has smoothly moved from less risky investments like bonds, savings account deposits, to more risky ones like equities and other assets. This kind of goes along with the email that I got from somebody who is kind of, I think, a newcomer to the stream. But generally, as stock markets do well, money tends to flow in to that market. And I think this is what we're seeing now. And, there's charts out there that will show you during, obviously, market dips and market crashes, the money outflows. When everything is going well, people shove more money in because they have a thing called FOMO, which is fear of missing out. And I experience it myself all of the time. I experienced it this week. I showed you in the Trading 212 portfolio that I'd added position in Coinbase and Rivian and watched them kind of take off, and I had set limits, buy orders to accumulate more of those shares at a lower price, and then the price took off and I wasn't able to buy anymore. So I experienced that FOMO. I'm thinking, well, should I just pile more money in now? Everything seems to be going up. What I've come to understand is really patience is a key when it comes to investing. But let's look at the mailbag. I thought this was a really great question, and it's something that's very, very relevant and poignant right now. So this came from Costa. His name is not Costa Coffee, Costa with a K. Hi, Lawrence. Wondered if you might be able to give an opinion. Yes, because as you know, these are always just opinions and not financial advice. I don't have a crystal ball. Well, actually, I do, but it doesn't work. It's useless. Lawrence, I've just come into a five-figure sum of money. I'm presuming that's supposed to be five-figure. So five-figure sum of money I want to invest. I already have quite a bit and put into Pitto Pit. I think that's what that's supposed to say. I was thinking about putting my money into an index tracker, as I know picking individual stocks is a terrible idea, especially when I have no clue what I'm doing. Absolutely right, Costa. Hopefully, Costa, you get to see this. My fear is because the stock market is so high, I'm presuming he means in value, because we are coming at that very high point. I don't want to put my money in and then watch it drop. Yeah, nobody does, Costa. I mean, that's not what we want to happen. Sometimes it does, though. Lawrence, how do you recommend I handle this? Do you think it's a good time to invest? I really enjoy the content you put out. I'm relatively new watcher. But keep up the good work. Thanks very much, Costa. Thank you, Costa. It's a great question. It's one that I think we've all experienced. You come into a sum of money and you're trying to figure out when is the right time to deploy. When is the right time to invest? Pitto Pit is kind of easy because you're not seeing these crazy fluctuations of volatility like you do with the stock market or some other investments. Pitto Pit, you just put your money in and hope the company does well. Hope you put your money into the right loans, or pick a pretty easy to manage investment, auto invest product, and you're done. You don't have to worry about timing anything. With stocks, You have a difficult decision to make, and especially right now, if we look at the chart, the S&P 500, let's have a look where we are. So we are at, we're not quite at the high, 4538, maybe we're getting close. So 4725, I think, was the high, and we're at 4716. So we're pretty close to an all-time high. So you have a decision to make, and it's one that I think we all struggle with. When is that right time to go in? And, that question of is this a good time to invest? I think we have to look at a couple of different things. We look at interest rates, inflation, what we think is going to happen with the economy. And we've seen interest rates announced today, Bank of England staying put at 5.25%. So right here, you can see that ladder of interest rates increasing, but they are going to stay put, which the stock market loved, by the way, because the last thing they want to see is an increase. We also look at inflation in the UK. It's horrific, 11.1% in October. Now sinking down to 4.6%, so heading in the right direction. And then we also we have to look at the U.S. because the U.S. seems to steer stock markets is what we're trying to figure out. Is investing a good time? We are now gone from 7 down to 3.1. So 2 years ago at 7%, now 3.1% annual inflation, CPI, heading in the right direction again. Now, if you look at all of those things, you would probably be correct in thinking that those numbers are heading in the right direction. So therefore, if interest rates drop, maybe people have more money to spend on goods and services, which also maybe makes the inflation rate increase again. That's a big unknown. Usually if people have more money to spend, inflation goes up. If interest rates stay the same, then the stock market generally likes that, and when those interest rates start to dip, people have more money because they're not paying as much in things like credit card debt. Well, not all cases, but loans, things like variable interest rate mortgages, those amounts tend to drop, so they have more disposable money to spend. That goes into companies, which make more profit. Therefore, you should see the stock market rise, and also people have more money to invest. So that technically you should see stocks start to increase. There is some really interesting information about, you can look at inflows and outflows into things like ETFs. So if you go to Lipper Alpha, which is a website, they have a UK exchange traded fund, which is similar to an index tracker in some ways if it's passive. They had a report in 2023 of November that says 949 billion is the value of all ETFs listed on the London Stock Exchange as of November 2023, but we've also seen almost $500 million outflow from active ETFs. Now, where is that money going? Some of it's going into passive funds like index trackers, because people start to understand that active ETFs are not really good. Then we see here 6.3 billion went into BlackRock's funds. We're going to talk a little bit about BlackRock too. But money is going into the market. So even from August of 2023, we've seen 902 billion was the value, right? So that value has now gone up to 949 billion. So it's a tricky time. We've seen outflows of the stock market in some cases, $49 billion of outflows coming from U.S. mutual funds and ETFs in October to 23. That means that people are pulling money out. Maybe they're a little bit afraid because the stock market's high or they're taking profits. I think at the end of the day, we know eventually some kind of a stock market retraction will happen. It always does historically. So there isn't any easy answer because we don't really know what's going to happen to the price. I think the best case scenario is if you're feeling, Costa, if you're feeling a little bit afraid of putting your money in all in one chunk, is just to put it in bit by bit. If you spread your money over a year period, cost average in, so you got 10 grand, put it in over 10 months, you're going to hit hopefully those highs and lows of those dips over the year, and you'll average out about where you should be. There are several articles out there that show the benefit of just putting the money all in one go and just leaving it. There's definitely economic data to show that is the best way to do it, but I think a lot of it comes down to emotions and how you're able to handle putting the money in one go and watching it. So whereas if you put in an over a period of time, you know that if 1 month it goes high, you think, wow, I've done really well. I put the money in, it's gone up a few percent. But then the next month you see it drop by, the same percent. And then the next month it goes down. You can kind of feel okay because you're putting money in at a lower cost and then averaging it out. And I think that is one of the main things that people struggle with. I mean, that email really goes to show you that's a very real emotion about not knowing when to put the money in because you're too fearful of watching it drop. Now, if you're I don't know how old Costa is, if he's young, it really doesn't matter, Costa. You put the money in and just leave it for 20, 30 years. I'm sure you're going to be very happy. But if you're older and maybe you're closer to retirement and you want to be a little bit more careful, then avoiding that emotion of especially FOMO, fear of missing out, is quite difficult. And I think averaging in is probably the best way. That's how I would personally handle it. It's how I've done things in the past. But I think in general, I don't know, it's just so difficult to say. If we look at our trusty U.S. equity index tracker and just what it's done over, 12 months, it's kind of been heading in an upwards trend. It was 700 pounds on the 15th. We're down to 690 pounds on the 20th of December, so almost a year ago, and now we're 832 pounds. That's crazy. So pretty big jump, and you're going to see that go up even more today because the markets have had a good run over the last couple of days too. But I mean, look at this. Year to date, 5.64%. Not bad. We had a bad year last year. And then, of course, this massive run we had at December 2020. The other problem, too, is if you wait and you are trying to time it at the right point, you experience some of the problems that I've had with the trading 212 portfolio about knowing when the right time is. And if you miss that run, imagine if you'd have waited during this year, missed this 27% up run on your index track and you were waiting for the price to come down. Look, it only came down 1.7% the next year and it's continued to go in the right direction. So you'd have missed a whole ton of upside possibilities from just sitting and waiting. So yeah, that's the problem with sitting out on the sidelines. I mean, look at some of these numbers for total returns. I mean, it's just crazy. 2017, 10%. 2016, 33%. 2019, 25%. 2020, 16%. 2021, 26%. This is the index tracker. This is just tracking the broad market of the S&P 500 and the Dow. So super big returns. Then 2022. This is by NAV, which is the price. Minus 9.6%. So yeah, I mean, you can't necessarily sit out on the sidelines. I think there's a lot of money that will go into the markets, especially when interest rates start to drop. People will go out of fixed rate, things like bonds and savings accounts that are paying 5% right now. Those interest rates start to drop down to 3 or 2%. You're going to see all of that money come back into the markets again. And yeah, it's pretty crazy. So I think the best way, Cost is just put bits of money in as you go through the month. Just invest once a month, whatever you're willing to put in, and just do it over an average. That would be my opinion. Let me know what you guys think out there. I'd be interested to read your comments about how you would feel putting your money in all at once when the markets were peaking. So, interestingly enough, too, on these outflows sheets, it also shows you where that money's going. So I thought this was pretty interesting. If you type in LIPPER, LIPPER, Alpha Insight, and you can type in UK ETF Market Report. It gives you one every month, but it shows you where the money's going. So you can see how it's gone into equities, which is stocks, some into bonds, nothing into alternatives and mixed assets, a little bit into money market, which is like a savings account. Also, it shows you where exactly. Now, in August, when I looked at this, it was going in equity US, was much higher. In fact, I could show you that right here. So you can see that I'm telling the truth. See here, equity US was 2.5 billion pounds, and the equity global 1.5 billion. That was really flipped around. Maybe that shows sentiment about the US, but still 3 billion into the US and 4.5 billion into global. And then smaller amounts into bonds and things like that. But this shows you where the money went. Look at this. 659 million pounds into BlackRock, iShares, World ETF. So that's basically just a tracker that tracks it's like a global tracker fund that's an ETS in US dollars. Before in August, it was all going into the S&P 500. Into the US. So 733 million went in. So there's been this shift of people coming out of the US more into global. The problem with these global ETFs is they're very heavily weighted to US companies anyways. So you don't lose all that much of the US when you go into these global trackers. But it is interesting to see where the money goes. BlackRock gets most of it. That is interesting because BlackRock's a really great marketing company too, by the way. You look at this and you come iShares, right? And then you can see up here iShares, tiny words by BlackRock. BlackRock is a massive company. They have like trillions of dollars under asset. I think like 9 or 10 trillion under asset management. It's crazy. So a lot of money coming into these global and US tracker ETFs. So I just don't really look at the expense ratios too on these ETFs, 0.03%. That's a lot. I don't know how much they have in that fund, but I think it's a lot. They're getting 0.03%. They're just tracking the index, so they're not trading anything other than just keeping it the same as what the indexes are. Yeah. Next, moving on, private equity. This is the Bank of England says private equity or private credit is vulnerable to macroeconomic shifts. We talked about the private credit market. So it's basically companies lending directly to asset managers who lend directly to companies rather than banks lending. Of course, the Bank of England has no interest in that happening because they're in the banking world and they want banks to lend money. They don't want private. So they put out these things like warnings. But I did a little digging on the Bank of England because I don't know how the Bank of England works. I never really looked into it, which is funny saying that. But I wanted to kind of dig around and see what the Bank of England was up to. The Bank of England, what they do is they get banks to deposit money to the Bank of England. So those banks have to. And those are money that's in non-interest bearing accounts. And then the Bank of England goes ahead and invests that money. And they pay for certain things to the HM Treasury. Like they have to pay a dividend if they make any money. They pay dividends, they pay their expenses. And that comes from investing. The banks, like Lwise and those high street banks, they're giving money to the Bank of England. The Bank of England is investing it usually mostly in gilts and treasuries and stuff like that. But occasionally the Bank of England does some really wacky things. They're a publicly owned company, it says. Some of their decisions, though, I was quite interested to see, and one of them was this. During the pandemic, the Bank of England decided that they were going to purchase corporate bonds. And that was to be a part of quantitative easing and to help companies out. They announced that they were ending this bond purchase because why would the Bank of England be even getting involved in buying corporate bonds? That's kind of crazy to me. So these are going to fully mature by the 5th of April 2024. Now, I wanted to know whose bonds they were exactly buying. And what I found was really weird. Look at this. This is what the Bank of England holds in corporate bonds. BMW, BASF, Eastern Power Networks, Iberdrola Finanzas, can't even pronounce it, Imperial Brands, Manchester Airport, Mercedes-Benz, Mobico, National Grid Electricity, Nestle Finance, Severn Trent Utilities, Southern Gas Networks, Volkswagen Financial Services, and the Wales and West Utilities Finance. Now, that is the entire makeup of, I think, that $20 billion bond, £20 billion bond purchases. Now, what's interesting to me is I wonder how they decide who's going to get all that money, right? All of these companies are basically getting money from the Bank of England in the form of selling bonds to the Bank of England. The Bank of England gives the money to companies like Mercedes and BMW, who are not UK companies, if I'm right. I don't know. Are they? They probably, I don't think they are. I'm pretty sure they're owned by international companies, and especially this Iberdrola Finanzas. I'm not sure how that benefits the British country at all. Why is that happening? So what is the point of all this? I think there's a lack of trust. You know, when we say we have a lack of trust in the financial institutions out there, this to me spells a big lack of trust. First of all, if you're going to help out companies, why would you not help out British companies by purchasing their bonds? Why would you purchase foreign bonds? That doesn't help the UK businesses at all. And also, it's pretty risky. You know, you're buying maybe things that are not paying a particularly high percent. That was one of the things they wrote in their report, was that their investments hadn't made enough money to pay the HM Treasury a dividend payment. So you're taking a ton of risk buying these commercial corporate bonds, which, by the way, I've always said to you, I don't like bonds and companies because they are risky and you don't necessarily always get a really good return. So the Bank of England has found that out and hasn't, in their report, you could read it if you want some snooze reading. They have it on the Bank of England's website. You read about how they've done with their bond investments. Not great. So took a lot of risk, didn't get any returns, not enough to pay the HM Treasury, and took a lot of risk with banks' money, which, look, I don't care about the banks, whatever, but you know, they're supposed to be operating in the best interest of the people, right? That's what they say on their website. We started over 300 years ago as a private bank with shareholders. In 1946, they were nationalized. Our mission that drives us is to promote the good of the people in the United Kingdom by maintaining monetary and financial stability. Yet the Bank of England is buying corporate bonds in Mercedes-Benz. Very interesting. I don't know there's really no point to all of that more than just to kind of open our eyes to the things that are going on out there, especially with even a behemoth like the Bank of England. Speaking of BlackRock, just to do a little bit of cryptocurrency, you know, obviously BlackRock is this behemoth of a financial company, close to 10 trillion under management, more going in every month. They are obviously very interested in cryptocurrency. They're trying to push through a Bitcoin spot ETF at the moment, which I think in January we should hear a final decision on that. I'm fully expectant that that would be approved, and then Fidelity, Grayscale, Invesco, all the big other companies will go in also and release their own versions. Bitcoin doing very well at the moment, had a dip. It was pretty nasty, but right now back to almost 43,000. So you see this dip went all the way down to 40 grand, 10% drop, just bounced right back. They call that a dead cat bounce. Drop the cat, bounces, drops again, goes back up. It's supposed to drop again, but it hasn't yet. What I wanted to show you is about BlackRock. You know, I'm obviously a big fan of Bitcoin. I've been for a long time. But Larry Fink, who was the CEO of BlackRock, who is now a big Bitcoin fan, also was not a Bitcoin fan about 6 years ago, where he said Bitcoin is an index of money laundering. Bitcoin just shows how much demand for money laundering there is what Fink says, in the world. Fink's comments came right after JP Morgan Chase CEO Jamie Dimon called people who own Bitcoin stupid, or crypto stupid. But now, basically, Larry Fink is a big fan. Oh, by the way, if you'd have bought in 2017, you could have bought Bitcoin at $5,800 US. So crazy, huh? But now, Larry Fink's attitude towards Bitcoin and crypto has really changed. He thinks it's absolutely wonderful, right? He's absolutely shifted because he wants to get this ETF approved. By the way, this is how much BlackRock has under management now, 9.43 billion. Look how much that has increased. It's a massive amount. But let me show you. I can't find the article. I've lost it. Anyway, he's pushing through this Bitcoin ETF, and from there will become an Ethereum ETF. He's very interested in it. Why is he so interested in it? Does Larry Fink really care? Does BlackRock really care about Bitcoin? The answer to that is absolutely no. They don't care. They don't care at all. What they care about is money. They care about getting as much money under management as possible, right? They had 1.3 billion under management in 2008. Now they have 10 times that, because every dollar that they manage, they make a fee from. So whether it's Bitcoin, or whether it's actively managed funds, which BlackRock has tons of them, they care about one thing. They care about making money. And the moment there is no profit in something, they will drop it like a fly. What they are trying to do is to appeal to the younger generation of investors who, people in their 20s, they like things like crypto. They don't want to buy boring index trackers, even though they should. They want to buy things like Tesla stock, high-octane things, Bitcoin. And as our generation gets older, these younger generation comes into the investment field, and BlackRock wants to desperately market to these people for them to adopt things like Bitcoin ETFs. It's quite a U-turn from 2017 to say Bitcoin is basically a scam. It's money laundering, blah, blah, blah. So while I think this adoption of ETFs will provide a massive injection of cash into Bitcoin, it's going to make the price explode, I believe. We'll see if that happens. I mean, the funds could get denied by the SEC and none of this could happen. You could see the price drop. While I'm a fan, I'm a little nervous about these big behemoth companies coming in and getting their fingers into something that is decentralized like Bitcoin. We'll see what happens. It's an interesting story. Bitcoin Private Credit Fund launches. There's a company out there that have launched a Bitcoin Private Credit Fund. This is crazy. They'll target 5% returns right here. 5%. Why? Why would anybody want a 5% return taking that much risk? What the fund is going to do is it's going to lend Bitcoin to a diverse range of institutional counterparties. and will implement a rigorous assessment of credit worthiness. But if you invest in that fund, you can expect to maybe get 5%, which is nuts. It doesn't make any sense. If you're going to take risk, and cryptocurrency is full of risk, it's absolutely risky. 5% is just not going to cut it. You're just better off buying the cryptocurrency yourself, like Bitcoin, just sitting on it. And chances are you're going to get a lot better than 5% over the long period. It always leaves me scratching my head when I see stories like this. Like, how can you market something with a 5% return? That's because people don't really understand risk. They go along with the people who are backing the projects or funds, like OpenAI chief Sam Altman. But that's what happened when people back Bernie Madoff. I'm not saying Sam Altman is the same. I'm saying you back a person because you believe in them. Sometimes that doesn't work out. Look at Sam Bankman-Fried, $10 billion in fraud. Madoff, $20 billion in fraud. So you gotta be careful. Take a quick look at the Trading 212 portfolio. And I think I've been rambling for a long time. Hit that thumbs up if you're enjoying the content today. I'm absolutely parched. I don't have any water. But I want to show you the portfolio because we've taken a pretty good turn for the positive after meandering around 17,800 for the longest of time. We finally hit a couple of good ones. Coinbase up 22%. Some of these oil stocks have rebounded a little bit this week. And then Rivian, look at this. Rivian, 1 week, 16%. And since we put in the money into Rivian, we are now up 29%. So those two stocks have really floated the portfolio. Now, believe me, these stocks are very volatile. Rivian could absolutely dump 15, 20% in a day, as could Coinbase. But my theories remain for Coinbase that if these ETFs do get approved, the stock price is actually going to go through the roof. The problem I'm having right now is I wanted to add to that position. You can see a couple of limit orders down here that I had put in a few days ago. Right there, 133, 135. Are those going to get filled now? It's difficult to say because we're hovering at the 150. What are we at? 152 now. So we'd have to see some pretty big retractions in price. Deutsche Bank has been doing okay. It's up 8.75 now, which is good. Flex still struggling with the natural gas, but not terrible. Norwegian Cruise Lines done better. We're up 12% now. And then Vermilion still kind of in the doldrums, but we've had a bit of a jump up from the week down here at $10 up to 12. So we've had a nice bit of price action. They are offering a better dividend now, so the market's like that. And then Green Power Mode is still kind of struggling. So I think the lesson here is to patience. I did liquidate a couple of things to go into these two new positions, but the thing is you got to be patient with stocks sometimes and just kind of let them ride out. We'll see what happens. I mean, the goal is to get this account to about 20,000 to make another donation to the two charities that I support, Forest Home down in Dorset for hospice, and then Dr. Paula's Worldwide Healing Hand. So fingers crossed this portfolio will continue to do well so we can give them some money. Yeah, we'll see what happens. Look at that, Coinbase up 12% in a week. It's very, very volatile. Please don't follow this. It's just designed for entertainment purposes, even though it's a substantial amount of money to be playing with, and it's not without research. It's not like I'm throwing darts at a dartboard, but yeah, please don't follow that. Anyway, that was a lot of information. Wow, we've been going at an hour. Just to let you know, I have reached out to some people to be guests on the stream. Lwise, Assets Capital. Who else? Oh, Rebuilding Society. Daniel has committed to coming on the stream in January, maybe even this month. So we'll see if we can get him in. But yeah, I'm looking forward to having that chat with him. Finally, it's been really a long time since I've been trying to get him on here, but we'll see. No promises. It's really depending on their schedule. See if you have any interesting comments. John Day says early adoption and inexperience, not a good mix. We are all wiser now. I would hope so. Definitely a little bit poorer and certainly wiser. David Wilson hasn't put any more money in Cufflinks because of the raised limit. And you can get 10% in crowd property. Yeah, I understand. Paul says he had a late payment with one loan in Cufflink, but they sorted it. Good. Blender offering 10%. Blend Network. Good to see Gunnar Cook winning in the law categories on the Pitto Pit Lending Awards. Just after the start of World War III would be a good time to invest. If it's over quick, you do okay. If it lasts, you won't be too worried anyway. Yeah, I think we'd have more things to worry about than money if World War III comes up. Dave also says drip feeding, so cost averaging is a good way to invest. Iberdrola owns Scottish Power, so investing in renewables in the UK. I stand corrected. I didn't know what Iberdrola was. Because I put that together, that list. I just found it literally an hour before the stream. I didn't have much time to dive too much into it. But I did think that seeing where the Bank of England put their money was really interesting. Anyway, I think that's it. I'm going to head out of here. Have a great weekend, everybody. Thanks again for coming to watch. Please support sponsor the stream. Cufflink, if you don't already. You want to go check them out. It's free to sign up. Go get yourself an account. Be back next Thursday as usual, all being well. And please subscribe if you want to be a Patreon member. Check out the link below. Obviously, there are costs to running the stream. And any support you want to give, thank you. And for all you who've been supporting for over the years, thank you so much for doing that. So enjoy your weekend. That's all I got for you this week. And I will see you next time. Take care. Bye-bye.